Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com. Well, we have had some really big movements in the market and a lot of volatility, and we've talked about some of the major fundamental themes behind these moves, whether it be commodities, whether it be the view of risk trends, and through risk, we've also talked a lot about the dollar yen, which has been my exposure to some of this movement, which is not necessarily even across the board, as we see that the S&P 500 is actually still I guess you can call that holding the line. It's becoming very violent. But I want to look at something in today's strategy video that is a little bit more big picture. It's not unique to the situation. This happens typically when you have a strong conviction-laden move. And that is unique to the FX markets in a certain way, but actually if you look at it from the perspective of capital flows, it is pretty universal across asset class. And that is the implications of one very liquid major, all right, or one very liquid component of a variety of crosses can drag those other crosses along if it's moving with concerted effort. All right, now we're looking at the dollar yen here, and I'm not necessarily referencing the dollar yen as an indication for all the other dollar pairs. In fact, if I were talking about the dollar pairs and I were saying that there was one particular dollar pair that was really guiding the balance of its crosses, the other majors as they are called, I would say that that would be the Euro USD. But as we've seen, the Euro USD has actually deviated quite substantially from a lot of these counterparts. Not so much that we haven't seen some positive correlation with the dollar yen, however. But I'm looking at the dollar yen, and we see the influence that this technical pattern has. This is a very clear, decisive technical pattern. Whether it plays out or not is not necessarily clear, but the implications of the pattern is very clear. And that clarity, that appeal, and certainly the conviction that builds as momentum on the decline increases, because this is not just a break below 116 and that's the extent of it. It is a reversal after a very massive run up, topped at 121.50 or actually a little bit above it, and then proceeded to dive in incredible fashion, clearing that technical boundary and setting off what is a long-term head and shoulders pattern, which is for the technician very appealing and very consistent. Right? Nothing's ever perfectly consistent, but a very consistent pattern as far as these patterns go in terms of repeating history. So this is a very impressive move. We know that the dollar yen is by far the most liquid of the yen crosses. I can establish that through the Bank of International Settlements numbers if I so choose. But it is generally common knowledge. The next closest of the yen crosses, the euro yen, is significantly smaller in total volume. All right. So that being said, what do I expect when the dollar yen is dropping? Well, a lot of this has to do specifically to what's going on with the dollar yen. All right. There are factors here that certainly come into play that are unique to this pair. Largely, the weakness of the US dollar is a huge contributor. There has been a significant drop off from the US dollar as its interest rate forecasts have significantly diminished. That is a big amplifier to the dollar yen's drop. That's absolutely true. There is also a uniform or consistent fundamental driver between the dollar yen and the other yen crosses. And that catalyst, which we have seen definitely take hold of recently, is the implications of risk trends. So when we look at the dollar yen versus the Nikkei 225, or we look at a variety of other risk instruments that we take careful track of, we see that yes, there is an intensity of risk aversion, which can be seen in global equities, U.S. equities, which have been holdouts, as well as the more sensitive, more easy to move, more volatile, if you will, asset classes like high yield and emerging market assets. All right, that intensity, that risk aversion, is a unifier. of the yen crosses. Not just the dollar yen that moves with risk aversion. It is most yen crosses because there is a very popular carry trade behind this market. Now, this absolutely is a factor that caters to a correlation across these various majors. But that intensity of risk aversion, the conviction of risk aversion, is still not certain, which is why you don't have the critical or crucial breakdown from the S&P 500. Why the Nikkei 225, the Japanese equivalent on the U.S. To the U.S. equity index, has only tentatively shifted below its trend line. Not really a confirmed and true aggressive break. All right. But there is another factor that comes into play in that when the dollar yen, whether we are talking about the unique catalyst from the US dollar side, whether we're talking about a more universal influence to the yen crosses through risk trends, this pair alone has so much volume behind it that it subsequently will have knock-on effect to the other yen crosses. All right. Consider the practical implications here. Dollar yen, most liquid of the yen crosses, has a significant sell-off. There is selling of the U.S. dollar. All right, we can see that selling has been strong against the euro as well. However, it was certainly back and forth in this past session, something that deviated from the consistency of the dollar yen's decline. But there is also heavy yen buying. Now, this heavy yen buying, if it were on a particular thin liquidity yen cross, like SEK yen, for example, all right, the Swedish currency versus the Japanese currency, then that selling, even if heavy, would not likely carry over to strong yen buying in a pound yen or a euro yen, because the SEK yen is not liquid enough that it naturally would instigate just universal yen buying across the board. I wouldn't react to a big technical break on the SEK yen in the same way as I would the dollar yen. The dollar yen having so much liquidity and so much influence that its major break, however, can definitely carry over into the other yen crosses. There would be so much yen buying on aggregate from this particular pair itself because it represents such a significant portion of the entire yen trading market that subsequently there's going to be lots of yen buying in the other crosses, and that's exactly what we're starting to see. Now, I want to talk about this because look at the intensity of this move. Look at the inference of what a technical break this is and how much momentum there has been here. This is very important if you're trading any other yen cross. We had this past session a sharp decline from the euro yen, but if the intensity of the dollar yen sell-off persists, it's going to clear a level like 126.50, which is much more significant. Pound yen, intense selling, very much influenced further by the dollar yen, outside of the risk theme, outside of the interest rate expectations from the British pound, which happens to also be deflating alongside the US. Of course, those contribute, but the dollar yen itself, so much influence, so much pull that it can leverage this down as well. Right? Easily, the kind of momentum, if we see dollar yen persist, can carry this lower. Now, we can also look into the commodity crosses, and we certainly have seen the influence there. The Aussie yen and the CAD yen, for example, bigger levels coming into view. But consider this: if this is a unifying move from the dollar yen's perspective, influencing all of its counterparts, all of its crosses, then what happens if there is going to be a stall and subsequent rebound? This is something that I think that we need to be ready for because markets don't move in straight lines. Even though I'm short dollar yen, does not mean that I just expect this to continue to drop in consecutive declines with big, wide range bars. I do expect that there will be periods of fits and starts where you have something of a rebound before it engages what could be a dominant trend. Obviously, it can be reinforced by risk aversion. That would certainly take over. But if there is a stall in the strong yen buying from the dollar yen, and risk themes themselves balance out, don't give the immediate influence to keep things driving, then we would also have to consider that there's going to be a rebound or a correction in the dominant trend. that might be a possibility here. For myself, on the dollar yen short, since I have a medium to long-term view, that doesn't necessarily shake me out. If it were reversing fully and would continue to rise, I would get out and book a profit or get out of break even if it was moving so fast. But if it's just a correction that I expect to reconform to that evolving trend to the downside, then I would either be very tactical and get out at the absolute low that I perceive and get back in once it rebounds. If you're getting very aggressive, you can try to exit at the low, buy and take advantage of the correction, and then take that profit and then re-enter a short once it peaks out in the correction. That's a lot of activity, and that really goes against my medium to long-term outlook for this currency pair. So what you can use, given that there is this level of correlation and influence originating from this pair or even through a fundamental connection like risk trends, I would look at something else that has very similar standing, all right, likely to move at the same pace, but has its own technical boundary to work with. If there were a correction in the dollar yen which alleviated the pressure on all its yen counterparts, then a bounce off of the Kiwi yen's support at 75, which is very substantial as support, as you can see here, would be more attractive. I can maintain my medium to long-term view of the dollar yen. Kiwi yen would take advantage of the corrective phase. It's a separate entity. It's not going to fully offset the position I have. So this is something I can use not necessarily as a hedge, but as an opportunistic ability to play a short-term view while at the same time maintaining my long-term view. Okay. Now this happens a lot. We're talking about the yen, but we've seen this happen with the dollar about a year and a half ago. Not necessarily recently, but the really aggressive dollar advance, for example, when we had the Euro USD absolute tumble. While it might have been more motivated by the euro, its influence, nevertheless, considering that this is the most liquid pair in the world, easily spilled over to all the other dollar pairs, and the dollar gained a lot of traction because the amount of capital moving from Europe into the US dollar led to an expectation that the dollar in general was a appreciating asset against all benchmarks, and subsequently the dollar benefit across the board. All right. This happens very frequently for most currencies. All right, you just have to be able to recognize when the key player amongst the crosses moves with definitive conviction and momentum. Then you can start to see the knock-on effects to its crosses. So keep this in mind as we see some more of these moves evolve. All right, we'll wrap it up here. We'll do our next strategy video tomorrow. Until then, good luck trading out there.